So, welcome back to another episode of the Backholder Pod. As you guys can tell, it's probably a record right after that interview because we all haven't changed our outfit. But anyway, I think we wanted to drill down deeper into the conversation in two specific areas. One, which is on the idea of reinvesting and why you like or don't like reinvesting. And maybe on the second part, we'll talk more about this so-called overvaluation or even seemingly a bubble being formed in the US market because as we know, in 2024 alone, I think the S&P is up close to 16-17% and it keeps breaking new all-time high. And even recently, just Tesla just went up like 10-15%, and you can see that why the three of them are so excited as well. But anyhow, let's first focus our scope on REIT investing. And I believe Kelvin did express his concern or opinion in the previous episode. And if you guys haven't watched it yet, please go and look at the interview with Junyuan first. But maybe we'll give the airtime to Kelvin and talk more about his whole idea around REIT investing and your own experience and why you have your own concerns in general.
Why my concern with REITs? So with REITs, I feel that it's more suitable for people who just want to preserve their wealth, not so much to grow their wealth. So it could be for retirees who's like 50 to 60 plus years old. Basically, you don't have much time to invest, but you still want to get some income. So that's where I feel dividend stocks and REITs would be useful. So if you're like someone in your 20s, 30s, 40s, or even if you are a full-time investor like Junyuan, personally, I feel like, okay, you are earning that dividend, then you are taking that dividend to cover your living costs. Then where's the growth from the portfolio coming from? So you have to basically find money elsewhere to pump the money back into the portfolio. In that case, how can you be a full-time investor? So that's what I'm thinking lah. But obviously, Junyuan make it work. So I have no idea how. So that's my beef with dividend stocks lor.
I think personally for myself, right, when I look at dividend stocks, you're basically taking the cash out of the equity portion of the balance sheet, right? So technically speaking, I think I did mention in the previous video as well, where maybe you can invest in growth stocks or even invest in the broad-based index, and then you do the selling manually or discretionarily. Like maybe you need, let's say you have $1 million portfolio and you use the 4% rule, you need 40,000. So every month you just take out, I don't know, 3,000, 4,000, you need 48,000, for example, and you need that, and then every month you just sell 4,000 worth of equities. I think in theory, if you really talk about it in a theoretical sense, right, it feels exactly the same thing. The company, whether it's the company issue out the dividend from the balance sheet or whether it's you do it on a portfolio basis, it seems the same to me. But of course, not discounting the fact that there are a lot of like literature, like finance literature saying that if a company gives dividend, it appears to be much more stable and then there might be some premium and all those kind of stuff. But I think if we take that aside, just on a theoretical basis, if you were to really compare, like especially on how the US market has been performing, a lot of people would be very excited in trying to put the money in the US market rather than just dividend stocks that are subjected to so many risks. Not only interest rate is just one risk. There is still a regulation risk. There is still all the FX exposure risk and management risk, sponsor risk, whatever kind of risk embedded in a normal typical company. And when you buy some of these large REITs, right, you are subjected to individual company risk. So I think that's something that we cannot discount away compared to just buying a broad-based index. So that's just I've always wondered, if I want to buy a REIT, it should be because the REIT is strong and I want to invest in that REIT just like any other company, and not so much because it gives out dividend. That's why I give it a premium or I add it into my position. So that's just my general thoughts about it.
I think to answer Chicken's question, the reason you want dividend, you should buy dividend stock and not the S&P is because S&P is a lot more volatile as compared to dividend stocks. So if you are relying on this stock for income, right, imagine your portfolio grows up and down by like 10-20% versus a dividend stock. The DPU, especially for Singapore stocks, their DPU is very stable. So if you see like the COVID time, most of them never really reduce the dividend yield also. So the good risk, the bad risk, I'd be hard to say.
But do you see the REIT ETF, the position, the portfolio net worth? I presume that it will be the same. If it crashes, it crashes. Everybody will die together.
Yeah, so it's not about the portfolio, it's about the DPU. Yeah, the how much is being paid out annually. So you are relying in on income. So even if the portfolio crash, right, like right now, what's happening to all the REITs, the DPU still remain consistent. So it doesn't affect your daily life. No? That's what I'm saying.
Eric, you have been investing, right? In these, what's your
I think the for REIT, right, when you see like the price crashing down, right, it somehow trickles over to the DPU as well. Like you don't see the share price of the REIT going down, but the DPU is unaffected. Very seldom. One of the strongest REIT, like the Maple Tree Industry, right, which I think the DPU is very, very strong. I think that REIT will find a flaw lor. When the whole market crash down, this kind of REIT will find a flaw. But for the normal REIT, the rest of the REIT that I know of, if the REITs market go down, right, they most likely their DPU also follow down. I'm not sure how it trickles over. I think it's the net property income and things like that. They start to take a hit, and then their operating cash flow also take a hit. Then everything take a hit, and then the DPU also take a hit. So
I think it's the DPU take a hit first, or people expect that DPU will take a hit in the near future. That's why price come down first. It's an investor, they suddenly realize, because say for example, just now we discussed right with Junyuan, he also mentioned that the smaller REITs, some of them is like when it comes to their debt financing, they didn't have fixed financing. So it's a floating financing, meaning that interest rate higher, right? They straight away pay higher costs to serve all these financing costs. So there's lesser money flow to the shareholders, hence lesser DPU. If you receive DPU, all this while is like okay one because you don't have to pay so much financing costs. Suddenly now you have to pay a lot more just for the financing costs, right? That's why people are expecting much lesser DPU in the future. So the smaller one, quite a number of them get whacked because of this. And also the smaller one, those that get hit badly was also like they have a much higher debt ratio. So that's the challenges some of them are facing.
But maybe my conversation back to what Kelvin is saying, right? Let's say you put it in growth stocks, whatever growth stocks even mean. Let's say you buy S&P lah. It's easier to quantify, right? You have both value and growth in S&P. So let's say you have $1 million portfolio, it gives you 4% return. Your 4% safe withdrawal rule. So every year you sell 40K for your income. Let's say you are already retired, you don't have active income. Compared to let's say you put $1 million in Singapore REITs, then hopefully they also on average aggregate they also give you 40,000. My logic is same. I think S&P, let's say it drops 20% a year. I think not hard to fathom a scenario like that. So let's say 1 million drops to 20%, 800,000, and then you still sell 40,000 because you need the income. Compared to let's say REITs, right? Let's take the last 4 years for example. After 4 years, I'm not too sure what the REIT came down. Maybe it came down 20-30% as well. So you are also taking a 30% haircut in your valuation, let's say to 700K, but you are still theoretically getting 40K back in terms of income because of the distribution. But then to me, I still think that by your net worth or your entire portfolio value is still down by a large extent. You got haircut, but you are telling yourself that, oh, because it came out from the balance sheet. But when, as in, you still got your dividend in your bank account. But where did this dividend come from? The balance sheet of the companies. Where did the balance sheet of the companies come from? The portfolio of REITs that you get, which is the same as when you sell out from the exposure of the S&P 500. So that's why it's a bit of a, to me, feels a bit like a mental gymnastics lah, that you are trying to convince yourself that, oh, I never sell my REITs. My REITs is still there. Even though the valuation comes down, is no problem. I still got the income. But the income comes from somewhere anyway, which is kind of impact balance sheet because facing many of these headwinds.
Actually, I don't know whether or not is it really like the whole income of the REITs. I think when REITs pay out 90% or more of their operating income, right, they actually save on taxes. Although I'm not sure how much is that tax, some of that benefit actually goes into your dividend. So instead of paying the tax, they choose to pay you dividend instead. And then they only keep like 10%. So that could be one of the things. You're not actually just selling part of the company. You're taking out the cash flow, operating cash flow, to give as dividends so that you get this tax relief lah.
Yeah, it's more tax advantage. But just respond to Chicken on these two comparison that you just mentioned, right? I think the difference between these two is that for REITs, right, it's very easy to understand because it is basically just building and then you are getting rentals out of it, right? So that's why you can clearly separate the two compartments. One compartment is the valuations of those building. The other compartment is that what is the operating revenue rental that coming out. So just take away that financing cost for a second, just comparing the fundamentals, right? So there are two parts there. And even if the REITs, let's say like your portfolio down from 1 million to 700K, right? You know that their DPU, you can look at it, let's say DPU is just constant now, okay? But the valuations of the building come down, right? But you are okay because you know that this is just valuation. So this is the REITs picture. But if you switch over to, let's say, the S&P, right? Maybe you just take a few companies, the big one, the top 5, and you just look at their fundamentals, right? There's no concept of their, this is their assets, because the largest company in the world, say for example, like Microsoft or Apple, right? They are not valued for their buildings. They're not valued for some tangible assets. They are valued based on their future earning power. And as all this, like let's say there's some hit into the macro, revenue slow down, their profit margin gets squeezed, then everything drop, right? You saw that the operating income, the free cash flow, everything go down. And then you don't have these so-called assets to help you cushion the valuation. So that's why when the price for all this, like, S&P, when they drop, right, it really dropped. You cannot segregate out these two parts. So it's a bit hard to do the gymnastic, like you say, oh, the building value drop, but I still get my DPU, my REITs still get their, like rental. So they have some comfort there. I think this is the main difference between these two. It's just different characteristics, not saying that which one is more superior than the other.
Okay, so then I think my follow-up question is, since Kelvin hate REITs so much, right?
Wait, I don't hate
Then,
risk. I
then
just want to be
would he still want to create? He said, I think in one of the episodes, he said that you wanted to start over your REITs portfolio. Can I understand the thought process on why you are intending to restart your REITs exposure?
You're asking me? You're asking me, right? I thought
Yeah.
you were addressing to Kevin. So I think this whole thing, again, I think flow back to the objective, because when we talk about all these REITs versus, let's say, like a broad-based investment, right? I'll say that the difference is really like what's that portfolio for? So when I think about REITs, right, I don't really think about like, oh, this is like, just a broad-based equity kind of investment. To me, it's more like, okay, I just close my eyes, imagine, let's say 10 years from now, I want to have some sort of cash flow that flowing in to my account, regardless of what happened to the valuations of the market. So in that sense, right, I would say that REITs I would say it's superior just because of all these returns. It's more like it's convenient, So you have cash flow coming in, and they are usually quite stable. Even we're talking about like DPU cut, it's not right. They are cutting from like let's say $1 to 50 cents. Usually when even there's a cut, they cut by let's say 10 or 20%. It's already quite serious.
Strong ones.
Yeah. So I'm not betting on those small one. I'm not betting that interest rate will come down, so the small one will quite big. I'm not betting on those. It's more like just if I'm going to invest, right, it will be like those large one, because it's more like just raiding up this portfolio that can give me some cash flow that I don't have to worry about the valuations. Yeah.
Would Kelvin ever consider that?
Actually, I started with REITs. I started with REITs and dividend bank stocks. It's just that like I say, it doesn't suit my current slow. Actually, probably yes. But if the longer you hold REITs, right, the better, because the DPU keeps going out, right? So eventually the compounding effect would be higher than growth stocks, maybe. Maybe not. Yeah, because growth stocks give much higher return. Yeah, basically it's too slow.
Right. So now, since you talk about growth stocks, right? So I think there were multiple exchanges during the previous discussion about how the US market in general, whether it's the Max 7, the strong companies, they all have been being brought up or bidded up in terms of valuations and might look toppish. You might think that there's an impending correction, etc. I think Kelvin did press on to talk about when he expects the correction to come, etc. But there was not really a very clean answer. So I just wanted to open the discussion to the floor as well. Maybe to Eric first on what's your expectations and how do you look at it? Are you also trying to time the market, or what are you doing with your US positions?
For the past 1 year, you've been asking the same thing. I mean, not just you lah. I mean, everyone is asking on the pot. What am I trying to time the market? No, I'm not. I'm basically out of the market because I'm trying to save up. Yeah.
Let's not talk about personal situation.
Yeah.
Let's say let's say you are also managing a portfolio right now, and what would you do? Maybe exactly in Junior's position, meaning mostly Singapore exposure, looking towards going to US. How would you be managing it?
I won't waste time with REITs. Yeah, I agree with Kelvin. Don't waste time with REITs.
So you are saying that REITs are stupid?
No, I'm not saying REITs are stupid. No, that's what you would say. But I think in the situation now, right, it looks like banks are providing more value. Even if you're looking at in terms of dividend yield, the banks are far stronger. Then the capital appreciation also, like, I think banks have a bit more space, headroom to grow compared to the REITs. So I really don't see like, so what's the attractiveness of buying into REITs at this current moment instead of banks, other than the price. I mean, the price is like, banks is like $20-$30. OCBC was like 14 now. But other than the price, right, the absolute price point, you can buy in smaller batches, right?
Yeah.
Yeah. So I don't know what's the
So Bunti, what are you thinking? What time with REITs?
Let me respond to Eric comment on bank versus REITs. I think these two, right? If you are a dividend investor, definitely these two are attractive because they are dividend yield attractive. Okay. But what's the main difference between these two is really what's your outlook on interest rate. Because if you say, oh, I look at banks are all attractive now, their dividends all looks okay. If the interest rate drop, right, you will see that the bank will be the one that gets squeezed, and REITs will benefit from the interest rate. So the direction of the interest rate will determine the relative performance of these two. I mean, the banks versus the REITs. That's the only one. The other, they are all, like they attract the similar group of investors.
Interestingly, if you look at the banks, right, their dividend payout ratio is only like 50% or less than 50% of their operating cash flow. So we compare that to REITs, right? They have a lot less buffer. So I really don't see like, okay, the banks cutting their DPU. So for example, right, if you say that interest goes down, for example, and then the NIM for the banks also drops, then they earn a little bit less, but they can still maintain their DPU, which means
It
that
won't
their
it
yield actually
won't
went up.
be a bit less if two things happen. One, interest rate drop, then let's say at the same time, they all is like, oh, I need to grab for the market shares. I just want to, like just keep on basically make their price more competitive. So if that happen, right, then their margin can also go down faster. So it really depends on how much competitions are. When banks they try to lend to their customers, it's also compete for the same business, right? You offer, let's say 4%, I offer 3.8, then Kevin offer 3.5. So it can go down very fast one. But it really depends on the competition's dynamics at that environment. But I mean, the good thing about Singapore banks is also because the big one, they are quite dominant and they can all just, hold hand together and don't screw the market together. So they can do that. I'm not saying that will happen, but let's say if competition happen, right, all this margin can wipe out very fast one. It can, not saying that it will. Yeah.
I mean, it's not the first time we have a cyclical market, right? If you look at past market declines, the banks, I would say that they somewhat able to maintain or even slightly increase their dividend. So
Yeah.
they are not in any sort of pressure. Unlike the REITs, once the pressure comes, right, through interest or whatever, not right, they straight away they will squeeze, and you will reflect in the DPU.
Yeah, that's true. That's true.
So that is the thing that I find that, wow, because I hold DBS and I hold the REITs, right? I look at the two, it's like, wow, cannot. There's no competition at all.
Okay.
Like, yeah.
There's one more thing is that, let's say there's some slowdown in economy, right?
Mm.
People just like, oh, I'll rather wait instead of like buying my car. I would rather wait instead of buying my house now. So this one also hit bank badly. So banks, they are attractive because now all the setup is like good for them. Of course, they are doing well, but they are doing a dividend payout of like, relatively smaller also because they try to buffer. It is very painful for them to cut the dividends. So they purposely maintain a lower dividend payout. But all these, they are, talking about risk factors, right? I mean, the key one will be all this, like the loan growth, the
But
business
if you
growth.
look at this reason that you give, right, I think you impact the REITs just as much, if not even,
If
in
you hit
terms of
if
business.
you hit all the, like the restaurant or the, shop in malls and so on, then it can get hit as well.
Which is why I'm saying, if you compare the two, right, even if the price go down, right, at least the bank still maintain your DPU. But the REIT side cannot. They will just cut it.
Not really. If you go and check the DBSEU, yes, mostly been flat before the whole 2022, around that area. So it was around like $1 to $1.02, $1.02, $1.50. Then in 2023, it jumped up to $2.30. You don't think this is a bit higher?
No,
than
their payout ratio is always maintained at about 50%, 40 something to 50%. They don't go above 50%.
Yeah,
So
so when
The
it went
recent one is a special payout, right? That's
yeah,
why it jumped to do something.
they have like, how much? How much did they say? They have like 2 billion or something lah. Like just treasury cash or something like that. So they say that is cash that they can pay out anytime. Yeah. So that's why I say their buffer is a lot stronger than the REITs. REITs have no such buffer. They have to pay out almost everything. Yeah. So in terms of like the
REITs buffer is the shareholders.
yeah, lor, they'll do this, what do you call that, a rights issue. Then that's very painful. Then you say, hey, you want to subscribe to rights or not? You don't want. Then you diluted, lor. it's like a little bit of a ransom, right? Like you want you holding, right?
Okay. Then question is right. Then why Eric is still hold REITs? You're so bearish on that.
I'm not like bearish. I'm just like comparing between banks and REITs lah. You look at banks and REITs, I don't see what's the value proposition for REITs currently against banks. They have in no world that they will win against the proposition. So I don't know.
No, it's the capital growth. So when rates reverse, the REITs price will reverse also. After that,
Valuation it's a valuation play lah. I can
Yeah,
say
correct.
I think for most people that look at REITs versus bank today, whatever lame margin of safety it means, people are just looking at valuation as a comfort, as a sign of comfort that they're buying at a much lower valuation compared to, I don't know, DBS is at what now? 1 point something, 2 times book. I don't know what it is lah. Don't quote me on that.
Yeah,
But
actually, I got a question there. Do you all know why the banks like valuation is based on their price to books? Why
Because
is it
their
the
valuation is based on the balance sheet. Imagine, let's say, if you do a takeover, right? So how do you value the companies, right? So there's two parts. The first part is really the balance sheets. So imagine they sell the assets that they can sell and then clear up all the liabilities. It's basically the book value. So that's one part. The other part is their ability to generate like revenue. Those are the new business part. So two parts. The first part is already big because they have huge balance sheet.
so in terms of ROE and all that, which one do you think is more important to value a bank?
But the ROE determines the premium that people are willing to pay. So why is DBS valued so highly compared to UOB and OCBCs? Because the ability to generate on that base equity. So that's why DBS has been very hard because of whatever channels that they have, whether it's SME banking, business banking, rental, the distribution that they have, etc. And of course, their low cost of, because a lot of legacy accounts that give them basically zero cost of financing, etc.
Yeah, and ROE also is a measure to see how efficient they are at operating the business, because they can have tons of assets that's not generating profit, right? Then your E base is big, so your ROE is low. So it's like high ROE means that they are good at management.
Okay, anyway, so you all keep talking about REITs and banks. I want to go to the second part really. So let's talk about the US market. So since Eric sidestepped the question and went back to REITs and banks again, so I'll get Bunty to offer his opinion because he's like the biggest US bull now. I think like I think in our previous episode, the stock market portfolio is at all-time high. And then Bunty has like 20-30% exposure to Nvidia, to Tesla, to Apple, to Microsoft. So Bunty, do you think that we are currently overvalued, and what would you say to people that are always trying to time like entry and say that market looks topish, they want to get a better valuation, etc.?
Yeah, I'll say I'm not the biggest one, right? I think Kelvin is the biggest one, right? I don't think Kelvin has other exposure except for US, right?
Total value, you are the biggest.
Nice, big. Yeah, so come back to questions on this topic or not. I'll say like companies, take Nvidia is the like the best example, because there are people who look at their trailing PE. Trailing PE, don't know what, 80 times, right? Wow, it's very expensive. Those are the, if you're only looking at the surface. But if you just look like one level, one layer down, right, you can see that, oh, actually all the projections about their coming revenue, free cash flow, those are still coming up, right? So I will just read one of the like small clip from the recent earning transcript, right? He said that there's this analyst just comment. I mean, he's answering the question after they said, got it. So this year we will see Blackwell revenue. It sounds like it's just like confirming that this new chip is coming, right? Then Jensen's answer was that we will see a lot of Blackwell revenue this year. Then full stop. It's like it sounds like nothing, but he's talking about something that is generating zero revenue now because they haven't shipped yet the latest generations. Then he just tell you, yeah, it's a lot. So I think among the analyst community, right, they all have their sources to know how much is coming in Q2, Q3, and Q4. So this is not like, betting something that is uncertain. This is really that they already can project the upcoming revenue, upcoming free cash flow that will at least like 2 times, right, compared to last year. So if you put that into considerations, right, yes, you can still say they are, pricey, probably forward PE 30 to 40x, but still it is a growth area, right? So I would say that that's the most extreme one. But if you look at other Magnificent Seven, I think in terms of their growth, you look at their forward PE, the PE multiple versus the growth rate, right? I don't think they are at bubble level. Yes, it is richly valued, but not bubble. Lah. So anyone who say that, oh, because the PE is 40, so I just want to wait, I just want to sell and buy back, I don't think that's wise. Because mostly they are looking at the price chart without looking at the fundamentals. If you look at the fundamentals, it's still strong. But that's the things. Anytime you invest in stock market, you are always taking the risk of fundamental may come down. This is true for every sectors, right? Like the banks, I can also tell Eric that, hey, suddenly their loan growth down, suddenly they are not able to, people don't want to spend all these things. I mean, it can happen to banks. It can also happen to any companies, right? So again, this group of people who stay away for a long time, they will just wait. I will wait until the stock market dip by 10%. They say, see, I told you, market is overvalued. Of course, then you will be picking up the peak, right? So by definitions, by construction, they are always right. But it's not wise, I would say. Probably they already missed the 2x before that, right?
So you're saying value investors are stupid?
Wow, dangerous, man. Tons of trap there. No, I would say, I would just say that this dilemma of looking at, stock market continue to, experience bull market, and then you look at it, you say, oh, it will come down, then you wait, and then continue to go up. You always have dilemma of whether should you, sell, or should you add, or should you wait. There's always this dilemma that play around. But my approach is that try not to do too much, try to have a consistent methodology, consistent approach when it comes to investing, so that you can have some zen in your attitude when investing. If not, you are keep on thinking in and out, and you are doing the actions in and out, right? Yeah, the actions itself, it will compound all this confusion. Because you have money stake, then you will just be very messed up in terms of thinking. I would say just take a step back and have a consistent approach.
So Bundi, right now, because you are still investing every month, right? But you are avoiding Nvidia, so you are deploying as the capital into other stocks.
Yeah, mainly ETF.
Or
Nvidia, I
ETF.
haven't touched since I think 2 years ago already. I think I shared my record to you all, right? So
But if you are buying into
nothing.
ETF and the ETF top holdings are those overvalued stocks, aren't you as a buying back into the same overvalued stuff?
Follow Mr. Lu, just buy and don't look at it anymore.
Because I watched like Adam Khoo's video, right? He would say like buy during market dips, not during the wave up, right? So actually, I feel that his method of investing is correct, but for people like us, the effect on our mental well-being will be quite bad if we keep trying to follow his style.
Yeah.
So I don't know which is the better way here.
Kelvin, I think Adam did buy back the Nvidia. That time he was saying he sold it, right?
Okay, so it's different story. So he bought back because he realized the intrinsic value is much higher. But right now, like 2024 July, the price has exceeded the intrinsic value, so he will not buy it now. So I don't know if Bundi is following this style of investing for stocks or not. Like if it exceeds your intrinsic value, you stop buying. Then if it comes down, you start buying again.
Yeah, I would say intrinsic value, I still do have my own calculations. But you calculate already, you look at the values, you don't take it too seriously. That one is just, it's just for own fun only. You don't look at the number and say, oh, it is 20% overvalued, let's sell the stocks. Don't do these kind of things. You do these kind of things, it's almost like you are telling yourself, oh, I really know their free cash flow, I can project their growth, and I trust my number is correct. And then based on my correct number, I think they are overvalued, hence I sell. Then after that, just one quarter coming, the result is like way above your expectations, right? Then it just show that you are wrong, right? And you are in that dilemma already. You want to, or should I buy back? Because now by right, the intrinsic value already need to be revised up, right? So rather than not spending time to these kind of things, I can assure you my approach, right, will not be the best approach. But when it comes to how to say the sanity, the mental health, right? I think my approach is superior compared to Adam's Khoo approach. Yeah.
That's what I'm following also. It's more suitable for beginner investors who is not doing full-time investing like Adam.
Yeah.
Who doesn't have a good team, including chicken.
I don't know where that came from. But anyway, if I can share my opinion on this whole overvalued trying to come in and out thing, right? So recently I've been studying Howard Marks quite a bit, and I think I did share with Bunti as well. I think I just recently finished a book. It's called this one. It's called Mastering the Market Cycle. Don't know if you can see. It's one of the Marx's book lah. And I've been consuming some of his recent podcasts. And I think there was something that I parrot quite a bit, and I really acknowledge and I really I can resonate with. So let's assume that now a lot of people are saying the S&P 500 is overvalued, right? So let's agree that the S&P 500 is overvalued by 30% today. I don't know based on what metric you want to use, forward P or whatever. And let's say that 30% is correct. Like we based on every method out there, we say that 30% is correctly overvalued. So now what you're gonna do? You're gonna sell out at 30% of a valuation. Then the question would then be, why sell at 30? Why not sell at 29 when it was climbing up and up and up, right? Why you didn't sell at 20? Why not sell at 25? Why sell at 30%? And then I think through history and through the test of time, right, we have realized that time and time again, stock market overvaluation will get even more overvalued, even more overvalued, even more overvalued. That's why bubbles are formed. So then playing this timing game, right, it's very interesting because at least from what he said, he actually made kind of roughly correct predictions of when the stock market is overvalued. But out of the last 50 years, he has made predictions 5 times. And that's only when the market is really, really, really crazily overvalued and not when it's like 20, 30%. And when I talk about crazy overvalued, it's at least a double, triple factor kind of overvaluation, meaning you think the S&P should be like at 3,000 points and it's at like 7,000 today, something like that. Rather than 20, 30%, and then you try to time the ins and outs and saying that this is overvalued. So that's the first point. Now, on the second point, right, I think I recently read this GS report from Goldman Sachs, right? And if you really strip everything out, because we say that Max 7 is very expensive today, and I quote, while AI optimism has pushed valuations for many of the large tech stocks to elevated levels, the valuation of the large 10 TMT stocks, and TMT is tech, media, and telecom, they are currently at 31 times. So it's 31 times expensive. I mean, if you compare to S&P historical valuation, it's at 16 times. So 31 seems like double. But then when we compare it to the peak of the tech bubble in 2000, it's actually at 52 times. And in the late 2021, when everything was crazy, it was at 43 times. So before the correction in 2022 that came, if you compare to the 31 times today, there is still another 30% leg up. So then if we are always in this whole push and pull, right? And the funny thing is, even though 2021 correction came, we are now at all-time highs again after 2.5 years. So what exactly is people playing? And then back in 2022, how many of the people calling the talk actually bought in when the market was crashing? So that then begs the question of what should you do, right? I don't know what you should do, but this is what I'm doing. I honestly don't really care because I'm very young. And at the end of the day, we are all net accumulator of assets. So you should constantly be buying, regardless it's 2021 highs or 2022 lows. When, like Calvin always said, right, when it goes up, you are happy. When it goes down, you cry a bit and then you buy some more. So that should be the approach if you are looking at it at a really long-term perspective rather than trying to time the ins and outs. And like I said, I do agree with Eric's point of view now is that even though it might be expensive, but I don't think we're at bubble territory. There are a lot of signs when we're in bubble territory, and I don't think we see a lot of those signs today yet. So yeah, that's my very long rant. Anyway, I don't know, anyone want to do a conclusion here? Okay, Calvin.
Okay, bye.
Okay. Hope that this is a good enough discussion. And if you guys have any comments, feel free to leave in the comment section down below as well. Yeah, if not, we'll see you guys in the next video. Goodbye.
Bye.